and welcome to this annual update of the Baillie Gifford UK Growth Trust. My name is Milena Mileva, and I co-manage this investment trust alongside my colleague Ian McCombie. BG UK is a concentrated, long-term, actively managed portfolio of what Ian and I consider to be some of the best British growth businesses. What does that mean in practice? Well, we aim to identify high-quality companies that enjoy sustainable competitive and cultural advantages and therefore have the potential to deliver superior earnings growth over many years. We then hold on to them long enough for their unique strengths to emerge as the dominant influence on share prices. However, when we reflect on the market environment over the past year, it has been top-down factors which have been critical in driving share prices. Inflation, interest rates, and geopolitics have all come to the fore. The higher interest rate environment has had a significant impact on the valuations of faster-growing companies, where forecast profits and cash flows are far out into the future. We are, of course, biased to investing in such companies, and the performance of the portfolio has struggled as a result. In addition, our UK index is dominated by a small number of large businesses, such as the oil majors, banks, and big pharma, which have outperformed strongly. We are still of the view that these shares do not constitute attractive long-term growth investments, but their strength in the short term has been a headwind. To put it simply, this has not been a favourable backdrop for this differentiated growth portfolio, and I'm disappointed to have to report on a year of poor relative performance. So what have we been doing? Our portfolio turnover remained very low, at 5%, which implies an average holding period of 20 years. Fellow shareholders should not mistake these low levels of activity for complacency. The reasoning here is that despite the valuation reset, we are confident that the business fundamentals and growth prospects of our holdings remain very strong, and the vast majority have continued to show pleasing operational and financial progress. Indeed, amidst all the doom and gloom surrounding the UK and global economy, we are encouraged by what we're hearing from our management teams and by their ability to find new opportunities to grow their business. For example, the plant hire business Ashtead, which is finding new areas to rent, very lucratively in the case of hiring out floor cleaning equipment. The platform business Auto-Trader, offering an ever-expanding suite of products to automotive retailers. Or hobbyist retailer Games Workshop, making progress in monetizing its deep pool of intellectual property across the broader media space. These are just some examples of the opportunities arising from your holdings, and the reason why we remain deeply enthusiastic about the businesses we are invested in. There is no denying, however, that the economic environment has become tougher and more uncertain, and it would be naive to suggest that our holdings are somehow immune to this. As we aim to hold future winners through the cycle, we have been carefully monitoring the financial resilience of the companies we invest in, and are satisfied that over 93% of the portfolio is invested in businesses with positive earnings or free cash flow. Furthermore, the Trust's holdings compare favourably to the benchmark in terms of their quality and resilience. For example, over 5 years, they have grown their revenues well in excess of the market, are generating higher profit margins, and have a much lower net debt to equity ratio compared to the market. For the small minority of unprofitable holdings, primarily early-stage businesses investing for growth, we are satisfied that balance sheet strength is sufficient to see them through a weaker macroeconomic environment. We made only 2 new purchases in the year: IT value-added reseller Softcat and Belfast-based software consulting and development firm Kainos. We think both companies enjoy very exciting long-term growth opportunities, driven by the growing need for corporates to invest in their IT estates. Importantly, both of them have established strong competitive positions, enabling them to consistently outperform the underlying industry and gain market share. For example, Softcat differentiates itself through the quality of service provided by its highly engaged employees who share in the success of the business. We believe that its business model and culture set it apart from its peers, and its scale and investments in developing its capabilities add to a sustainable competitive advantage. Ian and I have also been critically appraising the investment hypotheses for the handful of portfolio holdings, mostly online consumer-facing businesses, where short-term operational performance has disappointed, to evaluate their long-term growth prospects as well as their resilience in the current economic backdrop. This is what led us to selling your holding in Just Eat Takeaway, as we had growing concerns over the industry dynamics and the company's potential to achieve profitable long-term growth. Looking ahead, while share price performance has been challenging, there are some noteworthy indications of green shoots emerging. Operational performance is now being rewarded, and there is less correlation to what we saw in the earlier parts of last year, when all growth stocks appeared to be hit indiscriminately. This is particularly important for the UK Growth Trust, given our investment approach of selectively backing a range of individual businesses. However, there is no doubt that we are living in uncertain times, and there is a lot of pessimism out there. As active investors, we have the fantastic opportunity to form our own differentiated views by carefully assessing the unique characteristics of individual companies and weighing up their idiosyncratic risks and opportunities. Doing this while staying focused on the long term enables us to look to the future with optimism. We believe that the key to generating attractive long-term returns remains growth, quality, and resilience, and striking the right balance between that interplay. Our approach remains one of patient investment in a portfolio of what we believe to be excellent businesses run by sensible management teams. We remain excited by what the coming years will bring.